Hi everyone, welcome to the season 2 finale of Mom Autism Money. Today we're going to talk to Paul Curley, CFA, to get some exciting news in the world of ABLE accounts. But before we dive into it, we just wanted to take a minute here to remind you of the guests we've had on throughout this season so that you can catch up on any episodes you've missed over the summer. We kicked season 2 off with the founder of the first neurodiversity library, Lee Wiley-Midsky. And Lee joined us to talk about autism awareness versus autism acceptance month. This happens every year during the month of April, and a lot of times you see organizations looking to get you to donate during this time. So Lee gave us some great tips on how to identify the best organizations to give your money to, and when maybe you should hold on to your dollars and put them elsewhere. In episode 2, we talked to Shalise Hurd, aka the Autistic Travel Goddess, about her travels and how she affords them. We also discussed how she built her business and some different funding resources out there for autistic people who are building their businesses. Over the next 2 weeks, we talked to Dina Gassner about 2 different topics. The first was how to successfully apply for SSI, and this ended up being one of our most popular episodes to date. Dina is literally writing a thesis on the process, and she was super generous and shared her proven format to getting people in the door when it comes to SSI applications and the appeal process. The next week, we talked with Dina about vocational rehab, which can both help pay for college and fund entrepreneurial ventures for disabled people. And the different programs are going to vary a little bit depending on your state. We get into all that. In that episode, we also talked a lot about the college selection process and what worked for Dina's son specifically. Episode 5 was another really popular episode. We talked to Blake Bauman of Aspire Coaching about career and life skills for Aspie young adults. There were so many great takeaways from this one, but at the core of everything, it came down to this idea of supporting our young adults and creating a vision for the future that they can get excited about. Over the next 2 weeks, we talked to Joe Saul-Sehy of the Stacking Benjamins podcast and co-author of the new book, Stacked. We also talked to financial planner Brenton Harrison, and we talked to them about a whole lot of different aspects of retirement planning when you have an autistic child. We got into things like retirement accounts, asset tests, life insurance, and just a whole lot more. There's some really important information in those episodes, so if you haven't listened to them yet, definitely go back and catch those. In weeks 8 and 9, we were joined by editor and self-advocate Ariane Garcia and policy researcher Cristina Lopez. Joyce led this just phenomenal discussion on autism in the Latino community, where we talked about everything from diagnosis to transition to adulthood. And we talked about all of that in context of culturally informed interventions and other ways we can systemically up our game when it comes to serving the Latino community when it comes to autism. For episode 10, we sat down with Rich Davis, a retired Navy veteran, and we talked to Rich a little bit about his family's experience raising an autistic child in the military. We also get into how his family is currently accessing Virginia's Medicaid program. We talk about ABLE accounts, supplemental needs trust. There's actually a little bit of a precautionary tale in that episode when it comes to family members saving money for your children. Rich and his family found out that there was a secret fund, and SSI found about it before they did, and it led to all these troubles with their son actually continuing to get SSI. It's a really important story and one that happens a lot, so you're going to want to listen to this episode, whether you're military or not, want to have grandma and grandpa listen, anybody else in your extended family who might be trying to do a nice thing by saving money for your kid, but maybe doesn't know how to do it in a way that shelters it from those SSI asset tests. And last season, we actually only had 10 episodes. So this season, we are growing. We actually have 3 more. The last 2 episodes over the past 2 weeks, we talked to Corinne Schmidt of Wonder Mom Wannabe. In episode 11, we learned about the system Corinne uses to teach her children financial literacy skills. We also took a deep dive on money mindset. And we talked about ways that you can actually cultivate an abundance mindset, even when you're living in forced poverty. And that was really interesting because the way you apply it is going to be a little bit different, but it can still open up a lot of doors for you. Corinne also has a really effective color-coded organizing system that she uses for everything from organizing her house with her 5 children, all the way through organizing her financial paperwork. It's really smart and effective, and we discussed that last week in episode 12. Then today, of course, we're talking to Paul. As we prepare for season 3, we want to hear from you. If there are any topics that you'd like to hear covered here on Mom Autism Money, let us know by dropping a comment in the Facebook group, or you can shoot us an email at momautismmoney@gmail.com. Fun story, we actually do have fancy email addresses with our domain, momautismmoney.com, integrated into them, but the one that we actually check is that Gmail address. So again, that's going to be momautismmoney@gmail.com. Once we have your topics, we'll find an expert to address it and be sure to let you know when it goes live. We'd like to thank this season's sponsors, CalAble out of California and Able United out of Florida. CalAble has some fantastic educational resources on their YouTube channel, and while some of the content is geared specifically towards Californians and California state law, a lot of it can be a great resource regardless of where you live in the country. So be sure to check them out. And if you are a Florida resident thinking about opening an Able account, be sure to visit ableunited.com in the next couple of days, because right now through June 30th, you get a free $50 contributed to your account when you open it with a deposit of at least $25. So let's say you open an account, put at least $25 in before June 30th. The state of Florida will actually give you a free extra $50 to keep in that new Able account. If you're listening to this podcast because you work in this space professionally and you're interested in joining our sponsor list, definitely reach out to us over the summer. We'll be lining up sponsors for season 3, which we're planning on launching in the fall. We have individual episode sponsorships, but if you're interested in a full season sponsorship, like Safety Sleeper did last season for season 1, we do have bulk discounted rates for those season-long sponsorships. You can learn more about Safety Sleeper and what a great nighttime intervention it is for kids with elopement concerns at safetysleeper.com/MAM. That's short for Mom Autism Money. So safetysleeper.com/MAM. All right, there's been a lot of exciting stuff happening in the world of Able accounts since we last talked to Paul in the fall. We are going to have lots of links in the show notes today for you so you can see which laws we're talking about, how to find your congressional representatives, and places where you can compare plans across state lines. Without further ado, let's talk to Paul. Hi, everyone. We are here today with one of our favorite guests, Paul Curley. How are you doing, Paul?
Doing great, and thank you for the opportunity.
Thank you so much for joining us again. Now, we are going to be talking today about Able accounts, all things Able accounts, and we have some really exciting news. There's some legislative movement going on, even just in the past few days here. And I'm wondering if you can tell us a little bit about that, particularly about the Secure 2.0 Act. And I know there was stuff in there about Able accounts and potentially about even raising SSI asset tests. So I'd love to hear what made it in.
Sounds great, and great question. Secure 2.0 is a continuation of a prior retirement focused bill. The title is Earn Act, and it's really focused on a lot of different things that relate to retirement. One critical component, to that bill related to Able is the Able Age Adjustment Act, which was included in the final bill. As of today, it would increase the age of onset for eligibility to open an Able account from 26 years old to 46 years old. And there's a couple different impacts. One is that it would increase the number of eligible users from currently 8 million eligible users, to 14 million eligible users. So 7 million more people would be able to open up an Able account. And also that it is, broadly speaking, very well supported on the Hill, because there's 1 million new eligible veterans. So it does increase the overall users. It is a pro-veteran bill. The interesting ins and outs of the addition was that it originally did not include the wording, but Senator Casey of Pennsylvania did include the amendment to have the Able Age Adjustment Act include. So it's great momentum. There's a lot of ins and outs and things that happen between, bill passage. It did pass the Senate. Of course, there's a lot of, ins and outs between where it stands today and where it passes. But broadly speaking, it is moving towards actual passage. And broadly speaking, what people can do is that if they do believe that this is an important component, to contact your members of the House, members of the Senate, and just voice your support and your perspective. And especially if you're calling your own representative, they should be responsive, and they do record it down, and they do take note of all the calls, and it does go up to your members of Congress and Senate.
Awesome. Now, is this a bill that's originating in the Senate?
Yes.
Okay, gotcha. So
Yep.
it's still
Yeah.
so it still
Yeah.
has to go through the House, so it's still helpful to contact all of the people that represent you. And when people are doing so, they should probably get really specific, right? They should probably be like, it's important to me that the Able Age Adjustment Act is included in Secure 2.0, that the representatives understand that that's really important. Is that accurate?
That is accurate. A lot of what goes on is that the Senate component of the bill was passed, and it still needs to pass the House. At that point, there's a lot of negotiation between which versions pass and which ones are included. So as much as it has already passed the Senate, to the extent that you are making the calls to the members of House, that it also makes sense to also reach out to your members of Senate just to make sure that it doesn't get lost in transition, that all different members are contacted. And of course, as a quick side note, I before living in Pennsylvania, I was in New Hampshire, so it's very easy. There was only two Senate members of the Senate. There was only two members of the House, so 4 phone calls. It was pretty easy. Perhaps Bryn knows how many members are in Pennsylvania, but it is a much bigger state with more population. So if one has to cull down the list, start with your own members of House for your district and your own senators.
Absolutely, absolutely. And if you're listening to this and you're thinking, why are we talking about the Able Age Adjustment Act? My kid is autistic. When you're autistic from birth. So this doesn't really affect me because they were definitely had an age of onset before 26, right? First of all, it's good to care about other people. That's the number one thing. It's important to care about the veterans and everybody who has those later onset disabilities. Another big reason to care that we've talked about on the show before is after the Able Age Adjustment Act is passed, which we are super hoping for. But after that happens, is the next item on the docket still the Medicaid clawback provisions? Will that be the next kind of advocacy effort? So once we get that Able Age Adjustment Act taken care of, I know a lot of you live in states where you do still have to care about those Medicaid clawback provisions on able accounts. So is that kind of the next thing, Paul, I guess?
Absolutely. I do think on a separate though related note that there was final regulations that were created for Able. As a context, it's great that Able has final regulations for 529 plans, for example. They didn't have they didn't have final regulations for 20, 30 years. So obviously it was a priority at the federal level for IRS, for Congress, for House, that there were, final regulations for Able. And the reason why that I bring that up is that there continues to be that hanging clause around the Medicaid clawback provision. And so that your members of state treasurers through the National Association of State Treasurers is working to really cap that to 6 months. Right now, it's just open-ended in the final regulations, but the state treasurers are really trying to move that time period to a 6 month cap. And so it continues to be a federal issue. Also, what's intriguing is that there's a number of states, I believe very top of mind, there's 11 states that already sort of waived that provision. So there's the federal level, and so you try to do it for all states in one occurrence. But in the meantime, the states are also proactively trying to remove those provisions. So that'll be another item that'll be on our list. And I think that your perspective is absolutely right, where the history of Able is really, let's just get this live and then we can repair it and improve over time. And then I think that it's also, I'll borrow Senator Casey's words along the lines of like though it may not relate specifically to certain types of disabilities, just as it's very much of a scale game where if you have a product for 8 million people versus 15, that there's just more infrastructure, there's more better product, better platform, better features, just a lot of the ease of use, implementation sort of things can be put into place a little bit more effectively, and just reduces the costs for everyone, and just expands the eligible users just to make it ease of use really. And so it's a great proponent and it's a great bill. And then from that perspective, when one goes to the Hill for representing something that impacts 15 million people, your voice gets heard even that much more. So it's a great momentum builder for everyone.
That's really smart. That is incredibly smart. Now, also in the Secure 2.0 Act, I don't know if we want to talk about this, Paul. We can skip if it didn't pass or if it's not relevant. But there was also something in there about potentially raising SSI limits significantly, at least for the asset tests, not income as far as I understand, but allowing people to build up more savings, to put their money into more assets and still qualify for SSI. What happened with that part? Did that make it in or?
And broadly speaking, we're talking about the impact of assets of having over $2,000 for federal benefits, and so it's $2,000 for an individual, $3,000 per couple currently, and we're looking to, for the SSI limits, increase that to potentially $10,000 for an individual and $20,000 for a couple. So it were to be passed, it would have a meaningful impact and just really ease up the rules and just allow families to get up and started a little bit easier. Between the lines, as I look at the interpretation, this bill was also introduced in 2019. It's introduced again today, and it did get introduced. That being said, it seemed a lot more murky as to whether or not it would actually pass. And so that's in a little bit more of a wait and see mode. While it's very clear that the Able Age Adjustment Act has a clear supporter of Casey speaking on the Hill in committee, live recording, that it is something that's meaningful and everyone does gravitate around it. The SSI limit didn't really have as much clear delineation of passage. That'll be something that we'll be talking about in July, right? To see if that really does go through. But that being said, it is great that more flexibility, more saving, and of course that provides a longer running ramp, for opening up an Able account as well. So it's broadly speaking, continues to be a proposal that's in the works. We'll see if it passes. It also makes me think that because it was introduced in 2019, that it's introduced again this year, that the fact that it just continues to have sustainability in terms of just continues to be around a topic of discussion, that if it were not to pass in this bill, that it would be something that would be on the docket for a future conversation point and would be potentially be added into a future bill.
Gotcha. Are there any other, even since the last time we spoke, I think the last time we spoke was in the fall, has there been any news or any changes that people should be aware of since then?
I have four. Brand,
Awesome.
I have a list. I looked through it. One very quick item of interest across the industry is really the Able to Work Act, which allows people to save even more each year, if they're working. Currently, that is still on course to sunset in 2025. There's a lot of support to continue that legislation. Broadly speaking, it is not being abused. It is being supportive to the industry, and the family. So that's something that the industry is focusing on as well. From a product perspective, I don't know how many listeners you have in Hawaii, but there's a new Hawaii Able product out there on the shelf, and so they still haven't had a product to use. So it's great to have Hawaii jump in the ring and launch a new plan. There was an interesting twist around the Savers credit and Able accounts. For Able accounts, that it was Savers credit eligible, and that was special carved out, cut out special language to have it basically continue on, that it would not be impacted. There's a couple of for other types of vehicles being used for the Savers credit, there were tweaks and changes from let's just say credits to matches and all these different things, and it has to go into a retirement account, but there was not an impact for Able. So from that perspective, Able will continue and has language in there for being Savers credit eligible, and some more to come on that one. Let me in the last one, just broadly speaking, as I focus on market data a lot, but broadly speaking, Able continues to grow. That the assets continue to grow. The number of accounts continue to grow. People are putting their money in through automatic contributions. About 2/3 of accounts have made a contribution, and about 1/4 of the accounts made distributions. So there's money's going in, money's being used and saved, and money's coming out from the accounts, and that's great to see that it is being used. It's being used automatically, continues to grow. About what's very intriguing, and this is my note on all the market volatility and inflation, about 2/3 of the assets are in conservative investment options, meaning that it's not really impacted by all this market volatility. So we're talking about money market, FDIC insured type of accounts, where it's just not like there's just minimal impact or just very small impact on the value of the accounts. 1/3 of the accounts are in more moderate and aggressive investment types. So those are impacted a little bit more. But broadly speaking, when you talk about one investment vehicle versus another, for Able accounts, they are invested in target risk, as opposed to age-based or different type of investments. So I think out of all the investment products, Able accounts were probably the most protected from all the different market volatility, which is great to see.
No, that is wonderful. And are we still seeing these accounts functioning largely as people stashing away money for short-term needs, like things that might come up in the next 6 months to a year. So the balance is, I think the last time we spoke, the average was around $8,000. And so people aren't necessarily, if you're investing for the long term, then all of the volatility isn't necessarily an immediate concern, right? Because the market's going to go crazy over a 30-year time period in short bouts. But overall, hopefully it goes up. But when we're talking about investing for those shorter term goals, that's why those investments are more conservative. And so I'm just wondering if that's still kind of what we're seeing, how people are using them kind of just for those day-to-day needs.
It's really about half, and that's sort of what we're finding is that half the assets are being saved for longer term needs. Half the assets and accounts are being used for those shorter term needs. About one third of the accounts are making transactions at least once a month. And what's intriguing is that when we first saw that, it's like, oh, it's just once a month. That's not really volume. But then what we're noticing is that people are making the transfers from the able accounts to their debit cards once a month, and then they're probably using like say like 20 30 transactions. So when we saw it originally, it's like, oh, there's just one transaction a month, which is about more or less about half the accounts are doing like less than one. But it's like on the industry side, we see like one transaction, but then like at the debit cards, like most able accounts now have a debit card function, and then it's like you put the money to the debit card, and then you use the debit card pretty frequently. And a lot of those expenses are for food, for travel, for Uber, for going out to eat, for all these different living expenses, for clothes. And so it's great to see that there is a high volume. And as you said, it's good that there's a high transaction focused. And then of course, as you correctly point out, that's why that more than half the assets are in conservative investment options.
Now, with able to work, I'm going to try to circle back to all the things you mentioned because it was all great news. So with able to work, is there any specific legislation, like as people are contacting their senators and their congress people for the Able Age Adjustment Act, which is of utmost importance, it's immediate importance, and potentially at the SSI part of it, but it sounds like the Able Age Adjustment Act is the more viable thing to talk to them about in this moment. For able to work, is there any like legislation that we should be keeping an eye out on, that we should be contacting our representatives about?
And that's a great question. There's probably two different, ways to sort of answer that question. There's probably looking at the original legislation that did pass, and because there was the provision at the end that says it sunsets in 2025. And so when you talk to someone in the Hill, you can reference, here's a bill that passed. It sunsets in 2025. We would like to extend. But currently, my understanding is that there isn't a new legislation or proposal that would extend it. That would most likely get introduced in 2024 for passage in 2025. That being said, it's I wouldn't be surprised if it gets introduced in 2025 and then backdated that, like, oh, this is just sort of like road repaired, right? So it's really, I think a lot of it would sort of like come down to the timing of what happens in DC. But lo and behold, as one talks to the Hill, finding the original legislation.
Awesome. So I did have one other question. This year, the limit for contributions used to be $15,000. And then this year in 2022, that limit jumped up to $16,000.
That is accurate. That is live. And I think that not too many accounts, hit the limit every single year. That it's really, it's a more of a comfort item. That being said, there is that small impact to the able to work, because you don't really have to worry about the able to work component until you kind of max out your standard 15 and now $16,000 contribution limit per year, and then from there there's the able to work component that would be sort of tacked onto that number.
All right. And we do have some listener questions. So our first question is from a listener who says, I like to keep things simple and flexible with financial planning. Retirement accounts and a brokerage account is all I have, but an ABLE account may make sense to add to the mix. I would love to know when it does not make sense to have an ABLE account for your child. And this listener is in Pennsylvania.
I do know that there are slightly different qualified expenses between ABLE accounts and trusts, and there are certain scenarios where the assets that are in a trust can be invested in an ABLE account, and it gets pretty detailed pretty quick. So I do think that there's pros and cons of every single vehicle. And so just I would recommend the reader just to really fully, look at their plan disclosure. And of course, another great resource is IRS publication 907. Lo and behold, a lot of the questions that do come through, come from there. But the downsides of able accounts, that there are eligibility type of requirements. Able age adjustment not been a great example of if as of today, right now, if the age of onset was 30 years old, you're not able to open up the account. I do think what's intriguing that just sort of floats in the back of my mind is also that for able accounts, there are a number of states that have state tax deductions. So to the extent that in Pennsylvania, there's only three ways to reduce your state income tax, or three great ways to reduce it. Like one is the 401k contributions, the next one is more the health savings at FSA, and the third one is the 529 able. So I do think it's just thinking in the context of putting it into just a brokerage account versus an able account, that there's certain tax incentives.
Yeah, definitely. In Pennsylvania, I think there's only Pennsylvania and Mississippi are the two states that allow you to do full deduction on your state taxes. So however much you contribute, you can deduct that from your income for the year. And then there's like a whole lot of other states that have like a percentage based system. But for Pennsylvania, that makes a lot of sense. I also love that the able accounts allow you to use that money for housing expenses. I know that's something that those trusts don't let you use the money for. So I think it kind of sounds like sitting down with a financial planner and a lawyer who understands these type of accounts and investments, just because it's really hard to answer without knowing all the nuances of an individual situation. Like, are you trying to avoid asset tests? Are you trying to set things up so that after you pass away, your child will be provided for? It really depends on your goals. And then within that, all of those little intricacies of your own personal finances, I think.
Yep, and I think my only add-on would also be to say to be conservative in the definition of qualified expenses, right? So it's pretty clear on the IRS language in the plan disclosures what's eligible, what's not, but things that are a little bit more gray, perhaps one would want to use the assets from the brokerage accounts, and of course that's always part of the fun side of the different types of qualified expenses. What's clearly not, and what's more gray, and for those gray, like it may be a better idea to use a more brokerage account as opposed to able.
Now, what if we have our next question here. What if you're living in Pennsylvania, but you get relocated for work, or you want to move to be closer to family, or you want to move to a state where Medicaid is more accessible? So if you move, what are the impacts of having your ABLE account in your home state?
I mean, for me, I think about it as a state income tax, perspective of, does your current state have a tax deduction for using your state's able account? And so if the answer is yes, there's a couple different options. Like one is to just keep your current account, say in Pennsylvania. If you do move out of state, you can either keep the Pennsylvania account. Just one can only have one able account, so it's really but to the extent of one can roll over the assets from your current state plan to the other state plan, and you're just looking at the platform, look at the fees. Is there an initiation or open account fee? Is there ongoing fee? Are the investment options sort of the ones that you know and love, and look at the call center? So it's a couple different elements. So I do think there's options. I think one could either keep your current account, or roll over to a new one. So I think those are the two primary options there.
With Medicaid clawbacks, so in Pennsylvania, we're relatively well protected in most cases from those Medicaid clawbacks. Another state where that's true is like Florida, I know, Kansas to a certain extent. So let's say I'm moving away from Pennsylvania and I move to a state like Tennessee, where they still do Medicaid clawbacks. If I kept my account in Pennsylvania, would it be protected from those clawback provisions, even though I myself am in Tennessee?
That's a really good question.
Sorry.
I think that drives pretty deep into the details of looking at one state law versus another. I do think that there's a point that some states are very proactive in following up with the Medicare clawbacks, where other ones have the clawback provision but don't really enforce it whatsoever, just as a practice. And there's a third bucket of, like Oregon and the other 11 or so states that just have removed it. I do think that there is an interesting kind of twist, as I was watching some other presentations on able, as I do track and post and share. But one of the eligible expenses is burial fees. So to the extent that then one can find a way to spend down the assets, as opposed to being eligible for the clawback provision. I mean, obviously it's a very kind of sad storyboard. But I do think sometimes it's good to be serious and good to kind of be full about how we kind of approach the topic. So to the extent in the back of your mind, burial fees as a qualified expense, and to the extent that one would want to have a good final send off and resting place for the family and for you, that it is something that is a nice comfort clause in there, that you don't spend it down, it all goes. Like, no, there is that stopgap of burial fees. And to the extent that there's a very open clause, that perhaps there's things that fall underneath the burial fees that can be spent down, like like a food, like a gathering, or things like that it would be able to be spent down accordingly. So hopefully it's less of a issue for families, knowing that clause, but it is there.
Yeah, absolutely. And I think again with that, with just the average account balance not being in the hundreds of thousands of dollars or anything, it's very possible to actually spend down the money and actually have that go towards expenses that you might incur so that there is no money left for the state to take. And then the money you have in other accounts might be protected in different ways. Our next question, we've talked about this a little bit before, and I think this comes with a lot of nuance. I don't know that there's one specific answer, but the question is if there are specific income windows that an ABLE account makes more or less sense.
Great question. And one way that I like to think about it is that for able accounts, they were really made to help all families, save for these types of qualified expenses. That there was, even before able, trusts are and continue to be a great vehicle for those of higher income and asset levels, but it is expensive and pricey. That's why for able accounts, I've seen a number of plans where there's no minimums and it's no initiation fee. Like, it's just very inclusive of the types of folks that they're looking to appeal to. So I think, while it's not a specific number, I think as one glides up the scale a little bit for assets and income, that they do tend to gravitate more towards trusts, and then maybe at some point gravitating towards taking trusts with able accounts, where for a lot of families that able makes a whole lot more sense for the middle and average family to moderate and lower income kind of families. And to that extent, there's that you're just helping out that $2,000 threshold. Of course, we talked earlier about the that potential limit increasing to $10,000, but neither here nor there. It was really meant to be much more of an inclusive conversation for all families.
For sure, for sure. And then our final question here, what are some of the potential consequences if you open an ABLE account and later on down the road, for whatever reason, you find out it wasn't really the best choice for our situation? Are there ramifications that I guess people should watch out for?
I think it's a great question. I think people and families need to evaluate their able account, product, to see if it's the best choice. Perhaps annually or every other year, just to make sure that they're not paying too much in fees, and to that extent that the best solution is to roll over the assets from one able account to another. I do think it's an ongoing conversation that as the able industry grows, and as we think about how much it has grown over the past 5 years, and continues to grow rapidly, that the product offerings will change, that the plans will change, that the fees will change. And so I do think that is the end result, I guess. But to answer your question, what are the consequences? Perhaps just finding out that, well, perhaps you've been paying a slightly higher monthly, quarterly, annual fee that probably, should or would have otherwise. So I think that's where the consequences sort of end right there. Perhaps, as we were talking about before, that there's a number of states do provide state tax benefits for contributions for a number of plans. So perhaps you were missing out on those types of state tax benefits as well. So that's another component about the potential consequences. And I think based on my understanding, that's sort of where the conversation kind of goes. I do know a number of plans also provide sort of like matching. You open an account, you put $50 in, and then the program will put in $50. So there's a couple of different more marketing facing type of one-off, relatively ancillary in nature benefits that one may lose if one were not to use a specific plan. So there are a number of levers. There are a number of different features to plans. I would suggest people to, if you don't have a plan, or review and learn more. If you have a plan, it's a great opportunity to learn more and just take a look at your state's plans, looking at other states' plans, and just learn more and have the conversation with others as well. Because at this point in June 2022, a lot of it is that the product has been launched, that a lot of the rules and regs are there or approving. And then really it's just about how do we get the message out there to the space. when Able was first launched, it was put in perspective of, compared to HSAs and FSAs. If you have an FSA, with your employer, like, you don't pay it, but your company pays it, right? So they just sort of look to the extent of how does one compare to, that, and 529s, do cost less than HSAs and FSAs, but also trusts are just, a lot of them do cost, several thousand a year once they are set up. From a comparative standpoint, fairly expensive. And I do think, and I do know that as the assets increase and the accounts increase, and as we kind of talked about, that 8 million eligible users versus 15, once we kind of get to 15, those costs of initial and ongoing fees will drop rapidly and precipitously. That is part of the whole, startup costs, to just get a program and plan up and running, the infrastructure, the accounting, the accountants, the lawyers, just to sort of like get the plan up and running. But now that it is up and running, it's really just a scale game. So as that scale increases, that the fees, will come down. I think if we do check-ins on an annual basis, as we do with any product, it'll just come down, fairly rapidly. So more to come on that front, but its fees are coming down for Able accounts.
Thank you so much, Paul. Paul puts out a great newsletter every week covering some of the updates on all of this news, and we will link to that down in the show notes below. I would highly, highly recommend subscribing to that because it's just chock full of great information. We hope we'll be able to invite you back next season for another update. And of course, reach out to us anytime if there's any news we should know about.
Sounds great. Thank you so much.
Thank you so much to Paul, and thank you so much for listening. We are going to go back to our behind the scenes work here over summer at Mom Autism Money, but we're looking forward to seeing you guys again in the fall. Make sure you don't miss out on those new episodes when they launch. And the way to do that is to take a second right now, whichever platform you're listening on, whether that's Apple Podcasts, Spotify, Google Podcasts, maybe some other platform. Take a second and click the button to subscribe to the show. That way you'll be notified when we start dropping new episodes of Mom Autism Money again in the fall. All right, we hope you guys have a great summer. Bye.
Bye.